This is arguably the most important week on the economic news front since the summer jobs numbers. The FOMC is resuming its rate cut cycle. What does it mean? Where are the markets trading? And what are the levels you need to watch going into Wednesday's meeting? Let's dive into it. Obviously, all eyes are turned to the Fed meeting on Wednesday, and it's a pretty big deal. Why? Well, when we take a quick look here, one can observe that we went through a substantial rate hike cycle back in 2022 to fight inflation. We stayed at that level for over a year before the Fed started cutting rates and then paused, driven by concerns about inflation fears. We've been talking over the last, half a year about how this is likely going to result in policy error by the Fed. And clearly, with all of these job revisions coming in and the inflation numbers coming in relatively in line, it continues to suggest that the Fed probably should have been cutting much sooner. The bigger question on Wednesday, when the Fed meeting comes out, what's now, but first of all, let's look at the probabilities. Right now, the Fed funds futures are pricing a 96% probability of a one rate cut and only a 3.5% probability of two rate cuts. So, on balance of probabilities, the market, so the Fed usually gives the market what they've priced in. So, Powell's very likely coming in with 25. We're not expecting a surprise on that, but it's going to be the press conference that's going to be important because during the press conference, the Fed will Powell acknowledge that jobs are a much bigger problem than they have been making it up in the past? And will that change the rate cut path for the rest of the year? Now, when taking a look here out to December at the end of the year, there's now a 73% probability that there's going to be three rate cuts this year. So we're now talking about the September meeting, that October 29th meeting, a rate cut, and December 10th, another rate cut. So three consecutive rate cuts is what the market is currently pricing in. The bigger question is that when the Fed starts cutting, typically they will just keep cutting until they've reached their terminal rate. Currently, the market is pricing in a terminal rate near 3%. That's basically them cutting down to about this level over here. And now that may be where the market goes, and that's maybe correctly pricing them. At least that is until the December of 2026. But if the jobs numbers continue to deteriorate, if they acknowledge that the situation is worse than expected, will the SOFR futures start to price in a more dovish Fed? That is the puzzle to solve. Now, that's definitely what we're going to be watching going into the end of the week, and something that is going to be the most important thing of the week. Now, we do have options expiration at the end of the week. Typically, options expiration causes markets to do some pinning, which is like essentially a reduced volatility. But maybe, just maybe, the Fed coming in a little more concerned or dovish may cause the markets to leave that gravitational pull of the gamma pinning that occurs on an options expiration. So I want to highlight just a little bit about what market volatility is expected. Now, the two biggest open interest strikes on the S&P for this week is the 6,600 strike, but the biggest one is 6,500. So big open interest. On balance of probabilities, one should expect the market to remain tight in this range. What's particularly noteworthy from implied volatility perspective, for instance, tomorrow into the retail sales numbers, the implied volatility on the S&P is down to 6.6%. Nobody is expecting the market to make, at least no one's pricing in tomorrow to being a big market mover. So expect a little bit more of the same. And it kind of makes sense. Why would any big money moves be made right now with the Fed meeting just 48 hours away. They're going to wait until we're past that to make any major move. And this is where you can see implied volatilities for all of the expirations past the FOMC are 50% or more higher in that kind of 9.5 to 10.5% range of volatility. And so that is where we expected. The reaction that is being priced in for Wednesday right now on the straddle is anticipating about a 70 S&P point expected range on that Fed meeting. We'll watch over the next few days whether that changes. So what do we need to know technically about where the market is today? Well, I'm going to put this on a 4-hour chart and highlight that the S&P has been completing a number of upside measure moves. Actually, I'm going to do it on the S&P futures here. And I want to highlight that that there are two moves that I want to measure. I want to measure this original rally over here, and I want to measure this short-term rally that we've had over the last few weeks. And I want to point out that the target zones for both moves, the measured moves, were about the 6,600 level. And so here we are with an expected implied daily range between today and tomorrow of being incredibly low. That 6.6% implied basically suggests that going into the next few days, the market's likely to stay pinned in the 6,600 area, and the real move is coming after the Fed meeting. You got to expect that. Now, with the measured moves being done, this market is looking for a reason to begin some profit taking. The question is, will Powell be that trigger, or will Powell just give the market what they expected, and subsequently no major sell-off ensues from that? That is going to be the thing to watch as well. Now, even if we did get a sell-off, I want to highlight that it's going to take a lot of technical damage in order for the bears to actually gain any traction. The fib zone 50% retracement lies around 6,500. That is a very relevant level, because when I put on a daily chart, that is where all of the previous highs, which could act as support, are there. So the interesting thing is that even if we did get a fast sell-off on this market on the reaction to the Fed, if it doesn't break below 6,500, it could end up being bought on dip, sending the market back straight to its highs. We're going to need to see some significant selling in order to pivot the momentum and actually put the sellers in control. And at this stage, there's no technical indication of that. We'll definitely be looking how the market's going to be reacting later this week. We're going to do a live stream of in the post FOMC press conference reactions to the market to make sure we'll really see what did he say and how did the markets interpret it. Lots of really important things to observe there. Nonetheless, S&P remains in trend, losing some of its momentum, still some divergences in breadth and other things that are very typical of an overextended market. Measured moves are finishing, but no reason to begin selling. I want to also highlight the dollar at this moment is actually gravitating toward the bottom end of its ranges. This 97 level is pretty critical. That also equates on the euro with this 118 level above where all of its highs were. And it really at this stage, if the dollar breaks that, it's pretty significant. And if the Fed's dovishness, for instance, is the catalyst for that, there's a lot of vulnerability that the dollar will have a continuation to the downside. Now, has it broken down yet? No. Are we at a major support line along these previous lows? Yes. So we haven't yet seen that technical breakdown, but this is an incredibly critical level on the dollar going right into a very important Fed meeting. First rate cut in 8 months. This is going to be a really interesting thing to see how the dollar reacts. I know a lot of people are focused on the stock market and the reaction, but I actually, from a macro perspective, feel that the Fed is going to first impact the dollar and the rates markets, and then it's going to translate into stock market movement. And I think that's a very important thing to stop and reflect, that it's not going to go necessarily all into the equities reaction right away anyway. Just looking at the rates markets, and this is the key, right now you can observe that the 3-month SOFR futures out to December are now trading around 96.36. They've been more or less hovering around this area. So we're now talking about the SOFR futures more or less pricing in those 3 rate cuts. The interesting thing is, can Powell say something dovish enough for them to price in a 4th one? That I think is pure speculation. What I'm far more interested in is the December of 2026 contract, which is trading around 3% at the 97 level. This is where it's a really good. This is where you have a really good gauge of where the terminal rate may end up falling after a rate cut sequence. And so right now, near 3% is where they're at. A curious thing for me is that, will we see this breakout where it suddenly suggests a dovish Fed may be heading to 2.5% or even 2%. Well, obviously, that's not going to happen all at once, but watching this reaction and whether it bullishly breaks out in the post FOMC is probably the most interesting thing for me, because if the market is pricing in a much more dovish Fed, there are going to be all sorts of market implications that we have to keep an eye on. The other just last thing I want to touch on is that we've generally in the last month have seen considerable rallies in all bonds, as yields right across the entire curve have generally been falling. And so what we had was this 10-year breakout. It finished a measured move on the upside and is now paused. Odds are that we're going to be consolidating for another day or two, and the Fed meeting is going to potentially be the next trigger point for a move. Will we see rates continuing to drop on the 10-year with these rising? And certainly the most important interest rate benchmark in the world on this 10-year. And so it's going to be really interesting to see whether or not the Fed becomes a catalyst for this to continue to rise. You can also see that after an extended basing formation, the 30-year bond has really banged out a short-term low and broken out of a multi-month trade range of all of this price action that was its basic fair value zone. And so with this type of a breakout, will it stay above its 50-day moving average? Are we seeing the beginning of a new bull trend here? Boy, that's a really interesting puzzle to solve. This is going to be such an interesting week. Looking forward to keeping you all up to date. I am going to live stream on Wednesday after we see what is said during the press conference, and we'll look at the market reactions and what it means to you. So we'll see you all on then.